It doesn't matter what kind of trader you are, whether you're a day trader, swing trader, or scalper, if you're not performing top-down analysis on every single trade that you take, you're basically walking into the markets blindfolded. Before I mastered this, I was constantly getting blindsided by moves I didn't see coming. Then I figured out exactly which time frames to look at, when to look at them, and how to read them, and it changed everything for me. In this video, I'm going to break down the exact process that I use, the time frames that I trust, and how top-down analysis keeps me out of losing trades every single day. I'll even walk you through real trades that I took in real time to show you how you could apply it in your own trading. Let's dive in and make you a more profitable trader starting right now. I see so many traders overcomplicate what top-down analysis is when it's actually an extremely simple concept. And the goal of this video is to simplify top-down analysis so you can begin implementing it into your trading, literally starting after this video. And this was actually one of the first trading concepts that my father taught me 5 years ago when he mentored me on how to trade. And it's been a game changer in my trading career in honestly two different ways. Number one, it helps me prevent losing trades. And number two, it helps me differentiate between low quality setups and high quality setups. And that is invaluable whenever you're looking at a potential trade. And the way that this video is going to be structured is I'm going to break down first what top-down analysis is. I'm going to explain why it's important. I'm going to show you what specific time frames that I look at. And from there, we're going to be looking at some real life examples so you could actually understand my thought process when I'm looking at a trade, and you can understand what I'm looking for in each specific time frame and exactly how I make my decisions. And by looking at real life examples, that's going to help you apply everything that you're about to learn into your own trading. So all that top-down analysis is looking at multiple time frames. And one of the most common questions that I get asked as a trader is, Emmanuel, what time frame do you trade off of? And I'm not looking at one singular time frame. I am always looking at multiple time frames so I can have multiple perspectives of the stock that I am trading. And that's what allows me to have informed decisions. That's what allows me to see the bigger picture on what's actually happening with that trade. And this is what helps me prevent losses. And all that top-down analysis refers to is looking at the larger and higher time frames first to determine and develop a bias. And from there, you go to the smaller time frames to trade and execute on that bias. And all that a bias is essentially your determination on whether prices are bullish and likely to go up, or bearish and likely to go down, or if prices are sideways and they're likely to just chop around and not really do anything. So on the larger time frames, let's say your bias is bullish. You think prices are going to go up and you're liking what you're seeing on the larger time frames. From there, you go to the smaller time frames to find an identifiable setup and an identifiable entry for that bias on the larger time frame. So that's all it is, starting off at the larger time frames and then going to the smaller time frames. Now, one of the biggest mistakes that I see is traders completely ignore the larger time frame. They're only trading off the smaller time frame, and then they get confused when a trade doesn't go their way. And it's like, yeah, obviously you have to see what the bigger picture is doing. So why is top-down analysis so important? And it's important for a few different reasons. Number one, it's critical to establish that bullish or bearish bias before you take the trade so you can understand the direction of the trend. And this is another massive mistake that I see a lot of beginner traders make. A lot of beginners always want to go against the trend, and they resonate with this idea of catching the top or catching the bottom of a stock. And that's actually extremely difficult to do. Even the most professional traders, they can't really predict tops and bottoms with precision. Obviously, some are better than others, but if you're a beginner trader, why would you want to go against the trend? That's like driving against traffic on the highway. You want to trade with the trend, because your likelihood of success is much greater when you're trading in the direction that price is heading in, right? So it's really important that you look at the larger time frames and make sure that you're trading with the trend, not against it, all right? Number two, it's really important to establish support and resistance areas, places of supply and demand on the larger time frames. This is going to affect how well your trade could actually continue in your direction. Like, for example, if your trade is, let's say, into a really heavy area of resistance, it's kind of unlikely that it's really going to continue higher. It might end up kind of chopping around that resistance and even failing on that move higher. And this is also really important for targets, to know when you want to exit the trade and when your target is actually hit. Number three, we want to look for alignment. It's impossible to have alignment if we're not looking at multiple time frames. And the way that I would think about this is, let's say the daily chart is bullish, the hourly chart is bullish, the weekly time frame is bullish, the 15-minute chart is bullish, and then you have a 5-minute breakout setup. Don't you think that setup has a lot higher of a probability of actually moving in your favor, because all of the other time frames are bullish? And that's what you're looking for. You want all of the time frames to communicate the same thing. You don't want one time frame to tell you one thing, another time frame to tell you a different thing, another time frame to be bullish, another time frame to be sideways. The larger time frames are bearish, right? That's not alignment. That's conflict. You don't want conflict among the time frames. You want the time frames to be telling you the same exact thing. And that's what allows you to take higher probability setups, because all the time frames are communicating the same thing. It also helps you find higher reward to risk entries. A lot of times I'll have to look at multiple time frames to find my best entry into that trade, because not only do I want to take a trade that's going to go in my favor, I want to make sure I have a solid reward to risk, to the point where if that trade does work, it's actually going to make me a solid return on the money that I'm risking. So let's go ahead and break down the exact time frames that I'm actually looking at for my day trading. And at all times, I am looking at the daily and hourly time frames, and those are my higher time frames. So I'm always starting out looking at the daily and hourly time frames. That is what provides me the bias that I need to trade that stock. And from there, I go to the smaller time frames. So in the morning, when the market first opens between like 9:30 and 10:30 a.m. Eastern time, I'm primarily looking at the 1 and 2 minute time frames. And by the end of 10:30, I'm already starting to transition to the 5-minute time frame. And then for the rest of the day, from 10:30 a.m. to 4 p.m. Eastern, I'm primarily focusing on the 5 and the 15. And this makes it really simple for me. My higher time frames are the daily and hourly time frame. That's what I look at to establish my bias. And from there, in the morning, I look at the 1 and the 2 minute. And for the rest of the day, I'm looking at the 5 and the 15 minute. I don't need to see the 10 minute and the 20 minute and the 45 minute. I really don't need that, right? I like to keep it simple. And looking at the 1 and the 2, 5 and the 15, keeps it simple for me. And of course, the daily and hourly are my higher time frames. Now let's go ahead and break down top-down analysis when it comes to swing trading. So let's say you're looking at a monthly setup. Maybe you're doing some longer term swing trading. I actually call that core trading. Or maybe you're making a long-term investment. And before you make that investment, you want to take a look at the charts to make sure that everything is aligned. So let's say you see a monthly setup. From there, you could find an entry on either the weekly time frame or the daily time frame that could be a bit more higher, reward to risk. Now, let's say you see a weekly setup. What I would do first is take a look at one time frame above and also take a look at the time frame below. So if you're looking at the weekly chart, I would look at the monthly just to make sure that everything is aligned. So let's say you see an opportunity to go long on the weekly chart. Check the monthly to make sure it's not in like an all-out downtrend or extremely bearish. You don't need the monthly to be a picture-perfect setup as well. Just make sure it's overall aligned, because you don't want to go long on the weekly time frame while the monthly is just flat out bearish. So take a look at the monthly, make sure it's overall bullish. And once you get that confirmation, from there, you can go to the daily time frame to actually find an entry for this weekly setup, all right? And the same thing applies if it's a daily setup. You look at one time frame above, and then you look at one time frame below for your entry. So if it's a daily setup, check the weekly time frame for confirmation. So let's say you're actually looking to go short off the daily setup. You see a daily breakdown, you think prices are gonna go lower. Take a look at the weekly to make sure that prices like aren't into support, or make sure that prices aren't like in an uptrend or all out bullish. If the weekly chart confirms that that stock or whatever you're trading is indeed bearish, right? There's alignment between the daily and weekly timeframes. From there, you can go to the hourly time frame to trade that bias that you created on the daily chart, right? So the daily chart looks short, you check the weekly looks good, it's in a downtrend, it looks bearish, great. That's when you go to the hourly time frame to find a high reward to risk setup to trade that bias you established on the daily chart. So overall, it's pretty simple. Just use multiple time frames. It doesn't have to be this exact procedure for every trade where it's like, I have to look at this and then that, and it's like a step-by-step. If you're looking at a trade, look at the higher time frames, look at the lower time frames, and make sure everything is aligned. It's also really important to understand that you should only be looking at relevant time frames. And like I just mentioned, the general rule is to look at one time frame above and one time frame below. So let's say you have a 15-minute breakout as a day trade, and you know you're going to close out that trade by the end of the day. Well, looking at the monthly chart isn't really going to be useful. In fact, the monthly time frame is completely irrelevant if you're day trading, because the monthly chart is such a high time frame that it's not really going to influence day trading. So looking at it for a day trade is actually only really going to waste time and energy. So don't worry about the monthly at all. In fact, you also don't even really need to look at the weekly chart unless you're like looking at higher time frame support or resistance. However, though, if it's a day trade, looking at the daily time frame is going to be very significant, and I'm going to explain exactly why that's the case in the next section right here. It's actually blacked out right here, but we're going to talk about why the daily is so important. All right. Now, let's say you have a 15-minute and 1 hour breakdown setup. Looking at the 1 minute chart also isn't really going to be all that relevant for you. Maybe you could take a look at it just for confirmation, but if the 5 minute looks good, then there's no point of even looking at the 1 minute chart. It's just not going to be relevant. It's not going to make or break the setup. So if you're taking a 15-minute and 1 hour breakdown, maybe you could look at the 5 minute chart for confirmation, and then as long as the daily chart looks good as well, you're golden. Now, let's say you're taking a daily breakout for a swing trade. Looking at the 5 minute chart isn't going to be relevant. It's not going to matter at all. Maybe looking at the hourly, that could definitely matter. The hourly could play a part. And maybe looking at the weekly, like we just mentioned right here. Check the weekly for alignment, find an entry on the hourly. That could be significant. But looking at the 5 minute chart for a swing trade doesn't really make sense. Now, let's say you're taking a 1 minute scalp. Maybe this is a quick move. You know you're only going to be in it just for a few minutes. Looking at the 1 hour may not be that relevant because you're going for such a small move for a quick trade. Now, maybe looking at the 5 or the 15, that could definitely provide some useful information. But the 1 hour, it's just too large of a time frame to really play a significant part in your 1 minute scalp. And the reason why my top-down analysis is so unique and why I'm always starting off looking at the daily time frame for my day trading is because I am a gap trader. I like to trade stocks that had overnight changes in price. And every single morning before the stock market opens at around 8:30 a.m. Eastern, I do a scan and I look for stocks that had overnight changes in price. And these are called gaps. And the reason these overnight changes in price occur is because of the company reporting earnings, or maybe events within the company, or macroeconomic data, or some random news that dropped, and it causes traders and investors to buy or sell that stock in the post-market or in the pre-market. And it literally causes that stock to gap, where that stock is opening at a different price in which it closed the previous day. And this is a really good example of one. And this is actually a trade that I took today, and I'm going to break down the intraday setup a little bit later in this video. But this stock the previous day closed at around maybe like 1180. And then the next day, today, it opened at around 1350. And you could literally see the gap in the price charts. You could literally see that prices closed here the previous day, and then the next day they opened right here. You could see the gap in price, and that's why they're called gaps. But this is an overnight change in price. And I think this happened because of earnings. And that's the reason why I really like to day trade during earnings season, because a lot of companies, they report earnings either in the post-market or in the pre-market, and it causes their stocks to gap. And when their stocks gap, they present amazing opportunities for day trading. So that's why in the morning, I scan for gaps. And that gap, right, that difference in price on the daily time frame is what gives me the bias to potentially day trade it. Because remember, in the beginning of this video, we talked about that we look at the larger time frames first to develop a bias. And from there, we go to the smaller time frames to actually trade that bias. And that's exactly what gaps do for me. They help me determine that bias on the larger time frame. In this case, it's the daily chart. And from there, we go to the smaller time frames to actually trade that bias. And that's exactly what we do. All right. So when it comes to the smaller time frames in the morning, I'm looking, like I said, at the 1 minute chart, and then on the 2 minute chart. And then later in the day, I'm looking at the 5 minute chart and the 15 minute chart, exactly what we talked about right here. And my overall bias is if a stock is gapping up, meaning it has an overnight change in price to the upside, my overall bias, I would say 95% of the time, is to go long. If it's a gap up, I want to go long. Now, if it's a gap down, meaning it's an overnight change in price to the downside, my bias, I would say 95% of the time, is to go short. I want to trade in the direction of the gap. Now, there are some exceptions to this rule where I'll actually fade the gap. However, those types of trades don't come by. They don't happen every single day. So I'm not going to talk about the exception. I'm just going to talk about the rule. 95% of the time, I am going in the direction of the gap. And a lot of people are going to tell you that all gaps fill. Don't trade gaps or always go against the gap because all gaps fill. There's this idea, maybe you've heard it before. That is a myth. That is a complete myth, that all gaps fill. I'm a gap trader. I've been doing this for 5 years. Some of the best opportunities that I see in the markets are actually trading in the direction of the gap, where if it's gapping up, I want to look to go long. And if it's gapping down, I want to look to go short. Now, something that I really need to emphasize here is just because a stock is gapping up, opening in price to the upside, or gapping down, has an overnight change in price to the downside, it doesn't mean I'm going to trade it. Because every single morning, like there are some mornings where you'll see 100 gaps or 50 gaps or 200 gaps. I'm not going to be trading every single one of those stocks, right? Just because it's gapping doesn't mean I'm going to trade it. I need not only a high quality gap, and I actually have another YouTube video that I will link at the end of this video that will break down a lot more of the detail that goes into gaps and how to identify high quality gaps. I have a YouTube video just for that, so I'll link it at the end of this video. But not only do I need a high quality gap, I also need a high quality intraday setup. I need a high quality setup on the smaller time frames, and that's where we're performing top-down analysis. We look at the daily chart to look at the gap, to understand what the gap is doing, assess the quality of the gap, determine a bias, and from there, we go to the smaller time frames, whether it's the 1 minute, 2 minute, 5 minute, or 15 minute time frame, to trade that bias and to find an identifiable setup. And if you guys have followed this channel, if you've seen any of my videos, right, you know I only really trade two types of setups. I really only trade retracements or I trade breakouts, okay? This is called a buy setup. This is called a breakout, okay? That's all I trade. I trade retracements within an uptrend, or I'll trade a retracement on a gap up or on a gap down, or I'll trade a breakout on a gap up or a breakdown on a gap down. So it's very, very important. This is how my top-down analysis works. I look at the larger time frames, the daily chart, to assess the gap, and from there I go to the smaller time frames to trade that bias. Now, I just gave you a ton of different information, but from here, I want to show you some real life examples of some real trades that I have taken over the past few weeks where I actually applied top-down analysis. But before I do that, I have hundreds of hours of free education on the internet. A lot of that is on this YouTube channel, but I would also check out my free 10+ hour trading course that is genuinely better than most paid courses on the internet. It'll actually help build the foundation for your trading, and you could actually combine my YouTube material with my free 10+ hour course as well. I do tons of free trainings that are live like every other week or maybe once a month, so I would definitely attend those. And for anyone who is interested in personalized mentorship, you're looking to actually pursue trading seriously and you want a hands-on mentor and you want to potentially trade live with me every single day, I also help scale and coach a small group of students to become full-time day traders in my mentorship. So if you're interested in that, you could also apply for that in the description of this video. So the first few examples that we're going to look at is how I would use top-down analysis to actually figure out support and resistance areas. And support and resistance is extremely important in your trading because of a couple of reasons. Number one, it helps you pick targets. It helps you understand when you need to exit out of the trade. And it also helps you differentiate high quality setups from low quality setups. It also helps you understand whether your trade even has the potential to continue in your favor or whether it's actually, trading into a very congested area on the chart. So we have the ZVRA here, where earlier this week it gapped from 1175. That's where it closed the previous day. And then the next day it opened at 1031. You could literally see this gap in price on the chart. And this gap was actually pretty interesting because it was clearing this pivot. And pivots are going to act as an area of support. So we were gapping below this support, below this pivot, which is interesting. Now, let's say I wanted to potentially trade the ZVRA as a short on the intraday timeframes. What I'm going to do is ask myself, okay, great. This stock gapped below this support, it gapped down, so I'm going to have a bearish bias. But how much room does it actually have to fall? What could my potential targets be? So if I do take this trade on the intraday time frame, what kind of reward to risk should I expect? What type of targets should I aim for? So I'm on the daily chart. That's where I always assess what the gap is doing, right? And from here, whenever I am determining support or resistance, I always look to the left. So the stock is gapping here. I'm going to look to the left. All right, great. What's the next area of support? Where I'm going to go down. I'm going to go down until I find that area of support. So I see a pivot right here. I see a pivot right here. And then I see this prior high over here. So this entire area right here, where's the rectangle? is going to act as support. This is a potential target area if I wanted to short this. Not only that, you guys see this 200 period moving average. By the way, in my trading, I only use the 20 period moving average and the 200 period moving average. That's all I use. So you guys see this 200, that could also be an area of support. And that would basically be my target. And that's exactly where this trade ended up falling to. This trade broke down in the morning, and that's exactly where the target was basically. It fell directly to the 200 period moving average on the daily chart. So this is an example of me assessing a potential target on the daily chart and then going to the intraday time frame to potentially capitalize on that target. So there wasn't honestly that clear of a setup here. You could say that this is actually a 5-minute 1, 2, 3, right? And I would highly recommend watching my free course to understand that setup. But basically we have an igniting bar, that's number 1. We have resting bar number 2, and then we have this triggering bar, which is number 3. So that's the 1, 2, 3 pattern. And then of course this ignited this move lower. So my entry would be below these 2 candlesticks, okay? And my stop loss would be over the highs of the resting bar. That is what a 1, 2, 3 is. Entry below the lows, and then the stop loss over the resting bar. And I could have capitalized on this move lower and hit that target, which is the 200 MA on the daily, or this prior support area. Here's another example of using top-down analysis to find a resistance or potential target area on a trade. And this AAL, the American Airlines, was called as a long in my group yesterday. And I think the call was over like $13, somewhere around here. And it was more or less just a quick trade. It was like a scalp because prices were really closely following the 20 period moving average. And that's exactly why I use the 20 period moving average, especially this breakout here. This was beautiful. It went up, retraced a bit, based into the 20, nice breakout. But there was another mini breakout somewhere around here on the 15-minute time frame. And I actually recommended against this, right? And seemingly, it looks kind of good. It's respecting the 20 MA. It's in a really consistent uptrend. Looks good on the 15-minute chart. Let's look at the 5-minute. 5-minute overall looks good as well. In an uptrend, looks higher. Fantastic. Let's look at the hourly. Hourly is kind of extended. That's definitely a red flag. Extension is basically the distance between price from the 20 period moving average. So whenever I say extended, you could think of it as like overbought. So it's kind of extended, but you know, it doesn't really have that much resistance to the left, maybe at 13.16, right? Could definitely have one more pop higher, maybe to like 13.30, 13.40. So that could definitely make money as a scalp. However, you look at the daily time frame and what do you see? You see this 200 period moving average that is going to definitely act as resistance. And that's exactly what stopped me from taking the trade, because I'm noticing that, hey, this stock attempted to hit the 200 already, and it was rejected. And once again, it's attempting to hit the 200, but that 200 is a strong area of resistance, and it's kind of unlikely that it's going to break. Maybe it does break. Maybe it doesn't care about the 200 and it rips right through it. But from my perspective as a trader, and I'm looking at the reward versus risk, I'm taking a long that's directly into a, strong area of resistance on the daily time frame. And keep in mind, the daily time frame, that's a higher time frame. I'm going to respect the daily and what's on the daily, you know what I mean? So I looked at this and I decided not to take the trade, and funny enough, it never ended up breaking this 200. So this is an example of looking at multiple time frames and looking at what the next resistance area is. And that's why I love the 200, because whenever the 200 MA is flat, it acts as an amazing area of resistance or support. I'll show you one more example of a stock that's actually gapping into resistance. So this stock closed the prior day at around 48.69, and then the next day, which is this day, it opened up here at $57. Now you see a massive red bar, and this thing just absolutely got sold off. But I was never even interested in this gap as a long in the first place because it was gapping directly into a resistance area. So it gapped from 48.69 to 57 bucks, and that $57 is directly into these prior highs right here. And we could even look at the weekly to see if there's any other resistance. And what do you know? We have resistance up here as well, right? This is kind of like an equal high situation. So this stock basically gapped into a weekly and daily resistance. So if you ever want to look further back in time to find resistance or support, you can actually go to the larger time frame. So that's what I did there. I went from the daily to now the weekly time frame to see, is there any more resistance? And you could see that resistance right here. And that this stock gapped into that resistance and it instantly got sold off extremely hard. Literally, as soon as it opened, it just collapsed right back down. Now, I didn't trade this. Keep in mind, I like to go in the direction of the gap 95% of the time. So I didn't take this trade short, right? And I wouldn't have taken it short. Even now that I know that it dropped so hard, I still wouldn't have taken it short because that's not my strategy. That's not what I do. But here's a good example of a stock that gapped into a larger time frame resistance area, and as a result, it was a gap up. So gap up, in theory, we should actually continue higher, but it got completely sold off. Now let's look at an amazing example of a trade on a gap up. So this is the Joby, and as you can see, this is in a really nice uptrend. You can see how well prices are respecting the 20 MA, and we make this really strong move up. At this point, we're extended from the 20 MA, and this stock needs to correct. And the two ways in which prices can correct is either through a pullback, which is a correction via price action, right, like a retracement, or through time in the form of a consolidation. And Joby actually consolidated through time. This thing just went sideways for basically 2 weeks. And on this day right here, it gapped from 11.12 to 18.38. And we were essentially clearing the highs of this resistance area. And that's why it's so important to look for gaps that are either clearing resistance to the upside if you're looking to go long, or clearing support to the downside if you're looking to go short. You want it to gap above resistance for a long, or you want it to gap below support if it's a short. In this case, we were gapping above resistance since it was a gap up. And this actually triggered a really nice move higher. So I saw this in the pre-market. I saw that we were gapping above this base. We were essentially triggering a higher time frame breakout. And we also had 2 red bars the previous day. So there might have been actually some short sellers that went short these past 2 days and are now waking up to their positions underwater, which could put pressure on them to cut their losses and essentially cover their trades and buy back their shares, which leads to buying, which leads to prices moving up. Or some people maybe sold. They're seeing it's gapping up. They feel FOMO and they're going to hop back in. Regardless, when I saw it this morning, it was clearing resistance, triggering a breakout on the daily time frame. What's top-down analysis, right? At the top, daily time frame is bullish, triggering a breakout on this gap. Great. I go to the smaller time frames to find a potential setup. And what setups do we see? Well, right off the bat, we see a great little buy setup. We see a retracement. We have a nice move up. We have a pullback. Nice little entry doji bar. I have a whole video that talks about entry bars and the importance of having an entry bar for your setup. I highly recommend watching that video. Nice doji bar. Entry would be above this retracement right here, above the doji bar. Stop loss below the doji bar. We got this move higher, then another buy setup right here, another pullback, and boom, we have another move higher. Really, really nice. We look at the 15-minute time frame. We honestly see sort of the same thing. Okay, we see basically the same thing. It's not as clean, so that's why like off the 15, you're not gonna find a great entry. That's why it's so important to go to the smaller time frames, right? Look at the 5, great, we have a doji bar, we have an entry bar that we could use for our entry. Same thing here, we have a couple of doji bars and resting bars, entry above, stop loss below the lows of the retracement. We can even look at the 2-minute for confirmation. What do we have in the 2-minute? 2-minute looks overall pretty good as well. A little bit more sloppy, but nevertheless looks good based directly into the 20 period moving average. But I would say it looked the most clean on the 5. So I would just use the 5-minute for my entries. And that's the importance of using multiple time frames, because if you looked at the 2 or the 15, the setups were like okay, but if you looked at the 5, you saw some really nice entry bars. You saw some really nice ways to actually play the bias on the larger time frames. Here's another just beautiful example, and this is actually a gap down. And this stock gapped from 2019 the previous day on the daily time frame, and the next day it opened at 1885. Now notice it opened directly below this 200 period moving average. And that's the importance of looking at the daily time frame to not only assess the gap, but also assess where is their support. And you could see that like right here, it hit the 200, popped, hit the 200, popped, hit the 200, popped. Every time it hit the 200, it ended up rallying. Even here, it broke it, but then immediately shot right back up. So this 200 was a very clear support area for this stock. And then on this gap, we basically gapped directly below it, and we were gapping almost below all of these tails. Now, we did have some support right here, but overall, it's a pretty powerful gap, all right? And so this gap gave me a bias to go potentially short on the intraday timeframes. Great. I don't just short if I see a good looking gap down. I need to look at the intraday time frame. So let's start off looking at the 15-minute chart. What do we have here? Okay, so right off the bat, we have a sell-off in a retracement. Okay, great. I kind of like this retracement. Let me go to the smaller time frames to find an even better entry. And do we have a better entry? Absolutely. I mean, look at this 5-minute. This 5-minute, I mean, almost picture perfect. Drop, retrace, and notice how this retraced basically like 40 to 60% of the prior move. Like this was the move. It retraced around probably 60% of this move, which is what I like. I don't like to see super deep retracement, so I wouldn't want this to pull back all the way up here. If it retraced 100% of this move, then that's a little bit too bullish. But it retraced around 40 to 60% of this move. You could use Fibonacci levels if you want. And from here, it's a sell setup, right? I teach this in my free course. Entry below these resting bars, you could put your entry below this tail or right here, all right? And put your stop loss directly above. And by the way, this literally just continued lower the rest of the day. Absolutely beautiful setup. And by the way, you could have even went short every time it kind of got close to the 20 MA, right? If we look at the 2, let's see if we have any setups. On the 2, we actually have a bunch of setups, right? If you didn't catch this, right here we have kind of a breakdown. We attempted to break above, let me kind of zoom in. We attempted to break above the 20, and then we got rejected. Could have went as a breakdown here. Or even here, it was respecting the 20 period moving average. And this is why I like to use the 20, because prices and the 20 MA, this is that blue line right here. This is why I like to use this blue line, the 20 period moving average, because prices respect it during established trends. So, but I would say honestly, the best setup here was the 5-minute. And you could just look at the 2-minute or 15 for confirmation. And obviously the daily chart was so freaking bearish. But this is just a nice retracement, move lower, retraced, sell setup, move lower. Beautiful. And then the daily chart confirms that. We can even look at the weekly. Let's say we do want to look at the weekly. Weekly, we know that once we clear this support, we basically have plenty of room to drop almost until like right here or right here at the very least. And that's exactly where we dropped to. So weekly looked good, daily looked good. And that's how you perform top-down analysis. Now let's take a look at an example actually from today. So we're starting off on the daily time frame, and I actually saw this gap literally first thing in the morning at like 8:30 a.m. So this wolf had a nice uptrend, rising 20 period moving average, and this thing was actually consolidating between this like 550 area and this 470 area. So consolidated for a while, and then today it gapped from 545 and it opened at around 719. And as soon as I saw this, I'm like, okay, interesting gap. It's triggering this breakout on the daily time frame. Great. Does this have room to run? It's gapping to 720. Okay, I'm on the daily time frame. Let's do top-down analysis. Let's look at potential targets. So if we look to the left, what do we got? All right. Well, I'm noticing that right off the bat, this is kind of an area of resistance, right? There's a pivot here. There's a pivot here. We have kind of a big choppy area here. So this is going to act as an area of resistance. Excellent. Are we gapping above it? Yes, we are. Great. So we've cleared this area of resistance. Fantastic. What's the next area of resistance? Well, look to the left. We move up, find a pivot or a base right here. Okay, we have a kind of a pivot here. You know, it went up, moved down. Pivot here, went up, moved down. We have a pivot here, pivot here. We just have a lot of choppiness and congestion here. So this entire area is going to be an area of resistance. So draw that out, okay? And that could be potentially target. And honestly, let's put it like kind of like up there, just like that. So that could be potentially target. And that's the way I interpreted it. So I'm like, okay, 719, it has room to run to anywhere between 820 to like $9. And that was actually my first target. I thought $8 was my first target. $9 would be my second target. So great, this has 80 cents to $2 to run. Fantastic. Now let's go to the smaller time frames to find an entry. And the first entry that I saw was actually, it was off the 1 minute time frame, in fact. So this was actually very early in the morning. Let's go ahead and find it. It was right here. This was my first call out on the wolf. It was over this base right here. So that's over 740. And I saw this small little consolidation, stop loss 720. And it kind of chopped around for a bit, and then it absolutely took off, and it actually hit $8, which was my first target. So 1 minute looked good, but when I was looking at the 1, I also took a look at the 5. 5 looks good. In fact, it triggered, kind of based again, and set up for another breakout. Fantastic. So 5 minute looks good. What about the 15? The 15, let me kind of erase these. 15 doesn't honestly give us that much information, but looks good as well, right? We have a big bottoming tail, which suggests that the buyers took control, right? That means the sellers tried to sell the wolf off, and then the buyers rejected it, so that looks good. So all in all, great. And then, by the way, what do we have here? We have a buy setup, which is a retracement pattern. We have a nice move up, pullback, nice little entry bar, resting bar, entry above, stop loss below, and then boom. And this wolf was just fantastic. But hopefully you understand my thought process. We look at the daily, understand the resistance, understand that it's a gap up, triggering a breakout on that daily chart. And from there, we went to the smaller time frames. We looked at the 1 minute, the 5 minute, and the 15 minute. And that's how we developed our bias, and that's how I was able to capitalize on this trade. The last stock we're going to look at is the DLO, and this was actually a trade that I took today. And this stock had a nice sideways kind of consolidation, and it was gapping from 1166. It was already starting to move higher, and it was gapping from 1166 to around 1360. Now, this wasn't really a favorite because it was already moving up, and then it just kind of continued that move. I like gaps that actually shock buyers or sellers. So for example, let's say this was actually moving down and then it gapped up. It would be shocking all of the sellers from the previous day, but that's fine. It was already moving up, gapped up. So I'm thinking to myself, okay, what's the next resistance area? And I'm looking at it, I'm like, okay, there's kind of some strong resistance right here. So it's kind of gapping into this prior high, which I didn't really like. And even if you look at the weekly, right, we had a bunch of congestion here too. So it wasn't really a favorite for me when the market opened. It was on my radar, like I had it on my watch list, but it wasn't a favorite just because it was kind of gapping into the resistance, and then it kind of got sold off into that resistance as well. So it wasn't a favorite, but then as I was doing my intraday scanning, I just saw an absolutely amazing setup here, and I just had to play it. So this thing actually cleared that resistance, went right through it, and then just consolidated for literally, 2 hours? Not even. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Yeah, I don't even know. 2-3 hours, literally consolidated. And I mean, you could just see it. Picture perfect breakout. Entry above the base, stop loss below. It was a tight stop right? Like the stop was what? It was entry, I called it over 1454. Stop loss 1430 or 14, no, it was 1425. So it was like a 30-cent stop. And this thing popped to 1570. So you could do the math. That's like 3, 4, 5 R's, depending on exactly what stop you used. Beautiful. So on the 15, it looks amazing. I mean, we can check the hourly. Hourly looks good. Looks good, right? Looks strong. What about the 5? The 5 looks amazing as well. Look at that 20 MA. See how the 20 MA started to hug prices higher? Beautiful. And then, by the way, we had kind of a retest here. We moved up, kind of retraced a little bit, and then boom. So you could have, if you missed this original breakout, you could have actually went long here, stop loss below. And I bet if you go to the 2-minute, you could see that kind of retracement. Yeah, you see how it kind of broke out, retested this prior resistance. Now that resistance became support and liftoff. Beautiful. And this is the thought process, right? Look at the daily, establish what the gap is doing, assess the quality, go to the intraday timeframes to find a potential setup. And that's why my that's why my top-down analysis is so unique, because it's all about looking at the daily chart to assess the gap, and then we trade the bias of that gap on these smaller time frames. We'll actually do one bonus one, and this was a trade from yesterday, and this was the Paramount Skydance. There was some like crazy news about it about like UFC or something. I don't even know what the news was, but all of a sudden this thing literally went up like 56% in a single day. Massive green bar, and it was coming off a green bar the previous day. You look at the weekly, I mean, by the way, right into weekly resistance, right? Remember this 200 period moving average around 18 bucks. Huge, huge daily candle. And I saw this on the 5-minute chart. So what happened here, right? We went climactic. We went exhausted. Nice move up, kind of retraced right into the 20 period moving average. That's why I like to use the 20 and lift off. And notice how this stock accelerated. This is why I liked it so much for a potential reversal, because the bars became increasingly larger. Like these green bars started off small, kind of retraced, small, 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 and then it started to get bigger. Then doji, then a little bigger, then a little bigger, a little bigger, red bar, bigger bar, and then boom, the biggest bar was at the top. Did we get a volume spike? We didn't get a big volume spike. I like to see spikes in volume at the top. That can indicate a reversal, but we accelerated and we were really extended on the 5-minute time frame from the 20 period moving average. So we were overbought. And if you look at the 15, I mean, you'll see the same exact thing. Let's look at this 15. I mean, look at this. I mean, this thing went vertical, and that's why I liked it as a potential short. Went vertical. And from there, I went to the 2-minute chart for a potential entry. And actually, it wasn't even the 2-minute, it was the 1-minute. And I'll tell you exactly where I got in. I didn't see an entry here because it kind of just reversed, chopped around right here. You guys see this really small base? I got in below this base, and I basically just put my stop loss above. And boom, it just continued lower, right? So this is the importance of using multiple time frames to find an entry. Like on the 15, I don't see an entry. It just mooned and then dropped. I don't see a clear entry here. Even on the 5, I don't see a clear entry at all. You just have to hop in. That's why I went to the smaller time frame, and I was waiting for something, and then I got this small little base, and I was able to kind of trade it as a base breakdown, basically. And it was just an amazing setup. And by the way, go back to the 15. That was basically target. The 20 period moving average was target for this stock. And I liked it so much because on the daily, it was also exhausted, had a massive daily candle. And on the weekly, it was directly into that resistance area, right? So you guys see this thought process. I'm looking at the weekly for potential resistance or support. I look at the daily to find some information. I look at the 15, look at the 5. Then if I don't see any setups, I go to the 1 or a 2, right? I'm like almost a detective. I'm trying to find clues on how I could trade this setup. And that's why looking at multiple time frames and performing this top-down analysis is so important, because by looking at multiple time frames, you could find unique entries. You could find kind of make or break information, like before that, American Airlines, it was right into resistance, which was the 200 MA. So I couldn't take the trade, right? So you find make or break qualities in the setup, right? It's all about looking at multiple time frames and collecting clues. And when all of your clues signal that this is a great setup, there's nothing wrong with this, that's when you want to take the trade. All right, guys, that was probably a long video, but I really want to show you enough examples to make sure that this sticks. And it's really easy, right? We go to the daily time frame, understand what's going on with the gap, establish a bias, look if that gap is into support or resistance, understand the quality of the gap. And by the way, the linked gap video is going to be somewhere on the screen, and it'll teach you way more about gaps and how to actually identify high quality gaps. So watch that video as well. And then from there, we go to the smaller time frames to find entries and to find setups and to find ways to trade that strong bias on the daily time frame. And even if you're not trading gaps, I still want you to use this same thought process of looking at different time frames to collect clues, and always look at multiple time frames. It's going to give you so much information. If you're only looking at one time frame, you're trading blindly. Hope you found tremendous value in this video. Make sure you watch my free 10+ hour course. Like I said, it's honestly better than most paid courses. You'll really, really enjoy it, especially if you like this video. Like, subscribe, leave a comment, and I'll see you guys on the next video. Thanks so much for watching.